Following the demise of Chinese Bitcoin miners, Bitfarms, one of the largest crypto mining operations in North America, has seen an increase in mining productivity in addition to an overall increase in market share. Recent Bitcoin crackdowns in China have reduced the network fees for Bitcoin users worldwide. This chart shows the average network fee per transaction in USD, and in April of 2021, there was a blackout in China that caused the price of network mining fees to plummet as rewards among competing crypto miners was obliterated due to the loss of miners. This is bad for China, but great for the rest of the world, because who wants to pay more for mining fees? Shortly after, there was a crackdown that evoked a harrowing ban on Chinese crypto mining. The end result was a contraction of these fees. This can also be reflected in the following graph. Bitcoin miners were profiting during this period, but after the ban, these reduced hash rates certainly benefited the rest of the Bitcoin community. Chinese miners are fleeing China and relocating their mining operations in Russia or Kazakhstan due to their close proximity to China, in conjunction with lower energy costs. And some Chinese miners have relocated to Texas because Texas is a state that is very pro-capitalist, and they also possess some of the most efficient energy costs in America, which is an integral factor when conducting cryptocurrency mining affairs. Bitfarms had mined almost 400 Bitcoin in July of this year, while sustaining 99% clean energy output. So perhaps this could appease Elon Musk and his cult followers to placate his love-hate relationship with Bitcoin. Meanwhile, Google has stated that they will be relinquishing their ban on crypto ads. Back in 2018, Google suspended the use of cryptocurrency ads on their platform, as well as Facebook. This ban was prompted mainly because back in 2018, the price of Bitcoin rose to $20,000 and suddenly plummeted over 50%, resulting in a lot of lost money for those who bought at the top. But Google and Facebook have repositioned their stance on crypto, hopefully for the long run. Why is this good for Bitcoin? Well, I'm glad you asked, because a company with the reputation such as Google finally adopting cryptocurrency material sets an intangible standard for other companies. What this is implying is that there's enough public interest in Bitcoin and other competing currencies to begin accepting payments. When large conglomerates like eBay, Google, and PayPal begin to accept Bitcoin, this increases demand, which increases our equilibrium price on supply and demand chart, resulting in more profits for bullish investors. We can't talk about cryptocurrencies without talking about politics, because politics is heavily ingrained in the admission of crypto, whether we like it or not. The problem is that most politicians are recipients of the boomer generation, and some dating even further back than that. Imagine if your grandparents were trying to regulate Bitcoin, when many of them can barely send an email or change their profile picture on Facebook without some assistance. These are the people trying to regulate cryptocurrencies. While I can spend hours making videos on politicians and crypto, that's an entirely different discussion outside the scope of this video. But I will say this. Recently, Senator Elizabeth Warren urged her fellow constituents to regulate crypto by using the B word. And no, I'm not talking about Bitcoin, the other B word, bailouts. Senator Warren had this to say about Bitcoin. The bigger it gets and the more it stays outside the financial system, something goes wrong, there's a run on crypto, there's a problem elsewhere in the economy. I don't want the US taxpayer to be the one that gets called on to back this up. And what she's inferring is that somehow a bailout would be used to quote-unquote save Bitcoin. I think this is one of those rare occasions where Republicans and Democrats can finally agree on something, which is that bailouts don't work. Giving billions of dollars to large corporations, or in this case Bitcoin, is a fruitless endeavor. There's a reason why these businesses, or in this instance Bitcoin, would be failing, because there is a lack of demand for it. Injecting millions or billions of taxpayer dollars into these dying entities is like spending thousands of dollars keeping someone on life support when the doctor has informed them that they have a near zero probability of surviving. Even if it seems cold and heartless, sometimes you need to pull the plug because of an economic principle known as scarcity. Let the businesses fail and let the market do its job. If Bitcoin fails, sure, many businesses that rely on it would have to learn to adapt by accepting other competing cryptocurrencies or meet their demise. Additionally, how does one even bail out Bitcoin if we could? It is a decentralized entity, a concept that many politicians are not accustomed to, and that's why Senator Warren, among the countless state and foreign politicians, need to educate themselves before going on national television to explain concepts they certainly fail to comprehend. Although there is something more sinister going on that involves lobbying efforts governed by big banks. Bitcoin and other cryptocurrencies pose a serious threat to big banks because if people begin using crypto to make purchases, the banks don't receive revenue from processing fees, and people won't be depositing money in banks Instead, they're transferring their funds into crypto wallets. When banks don't have control of your money, they become less powerful, which is why many banks are lobbying against crypto because of the potential threats confronted with this magic internet money, and that is one of the many reasons why I am in favor of crypto. While some crypto analysts claim that the upward price action for Bitcoin is attributed to the Wyden-Loomis-Toomey amendment, the actual cause was most likely driven by the $625 million Bitcoin option expiring on Friday. We will, however, see some serious volatility in either direction when the White House becomes partial to one of the amendments, depending on which amendment is ratified. If the Wyden-Loomis-Toomey amendment is affirmed, this should favor bulls, since this is more beneficial for Bitcoin hodlers, and if there is more regulation, though, through the support of the opposing amendment, this would certainly favor the bears. For those not familiar with option contracts, an options contract is defined as a mutual agreement between a buyer and a seller that gives the buyer the right, but not the obligation, to buy or sell a specific asset at a specific strike price on or before a specific expiration date. That expiration date was on Friday, and we see the price continuing to climb as it has done in the past when Bitcoin operations expire. After nearly 2.5 years since it was originally proposed, EIP 1559 has finally arrived. 1559 marks one of the most significant protocol changes in Ethereum's history, completely overhauling the fee market and improving the user experience of paying for the network's precious block space. The London hard fork also introduces a burning mechanism where a portion of transaction fees paid to miners or validators, which will be removed from circulation forever, thus benefiting Ethereum users around the globe. Anytime the Ethereum network is used, it's being burned, meaning that every time a trade is made on Uniswap or engaged in some NFT hysteria, Ethereum holders essentially get paid through this mechanism. The fee burning, in conjunction with the massive reduction of block reward issuance from the merge to proof of stake, could result in either having a deflationary supply and thus satisfying the wet dream of any Ethereite ultrasound money. Ethereum has been on fire lately, both in the sense of burning, in addition to its overall asset price levels, recently surpassing the $3,000 psychological price level, just shy of its all-time high of almost $4,000 in early May. Wishful thinking would have us to believe that the price could easily surpass $4,000. Some might say this is pessimistic, but it's just being realistic. If Ethereum reaches $4,000, this would result in a double top pattern, which could trigger the price to reverse, falling back down to $3,000. Sure, you could buy at $3,000 and hold to the moon, but in order to maximize profitability, wouldn't you want to sell when the asset price plummets and buy again when it's cheap? Many newer Ethereum investors are not accustomed to these technical patterns, and that's why understanding the technicals separates the men from the boys. Keep studying and remember to like and subscribe.